Hi, and welcome to English-Fabule. Are you learning English? Great. Let's learn English with a very interesting story. Don't forget to subscribe, like, and comment. Let's get started.
In March, a bank suddenly became the center of global attention. This bank was Silicon Valley Bank, or SVB. For many years, it was a very important bank for the technology world. It helped new tech companies and the investors who give them money. Before this time, most people outside of the tech industry did not know its name. But over one weekend in March, everything changed and everyone was talking about SVB. People and companies with money at SVB became very scared. They heard that the bank had serious problems. They all tried to take their money out at the same time. They used their computers and phones to move millions of dollars. This is called a bank run. But this one was different. It happened in just a few hours, not a few days. The government had to step in. Regulators, the people who make sure banks follow the rules, worked all weekend to stop a bigger crisis. This story is more than just the failure of one bank. It is a chance to understand how modern money and banking really work. It shows us what is happening behind the scenes when we use our bank accounts. The entire banking system is built on an important idea: confidence. Confidence is the trust and belief that your money is safe. This story shows what happens when that confidence disappears. In our modern world, information and money move at the speed of the internet. People can share news and warnings in seconds using group chats and text messages. We will see how this new speed changed everything. This event was a big test for the whole banking system. It teaches us important lessons about our money today. 2. What is a bank? When you put money in a bank, it does not go into a special box with your name on it. Instead, you have a promise from the bank. The bank promises to give your money back when you ask for it. This promise is called a deposit. So, what does the bank do with all the money from deposits? It does not just keep it in a big room. Banks use this money to help the economy grow. They lend it to people who want to buy a house or a car. They lend it to businesses that want to open a new shop or build a factory. This is very important. Banks turn people's short-term savings into long-term loans for others. But this system also creates a risk. The bank gives out long-term loans, like a 30-year loan for a house. But you can ask for your deposit money back at any time. If many people want their money back on the same day, the bank will have a problem. It cannot get the money back from the long-term loans so quickly. To keep banks safe, there are two important ideas: capital and liquidity. Capital is like a safety cushion. It is the bank's own money, not the depositor's money. If the bank loses money from a bad loan, the capital is used first. This protects the money of people who have deposits. Liquidity means having enough cash to pay people back. A bank needs to have enough cash available every day for customers who want to take out their money. Banks must hold cash or things they can sell very quickly. Interestingly, loans create new deposits. When a bank gives someone a loan, it puts that money into the person's bank account. This new deposit is new money in the economy. Because of this system, confidence is the most important thing. People must trust that their bank is safe. To help with this, governments create deposit insurance. In the United States, the FDIC, Federal Deposit Insurance Corporation, protects your money up to $250,000 in each bank. This insurance helps people feel safe and stops them from panicking. It is the key to keeping the whole banking system stable. 3. A different kind of bank. Silicon Valley Bank, or SVB, was not like most other banks. It had special customers. For many years, it worked with people and companies in the technology world. Its customers were new companies called startups. The investors who gave money to these startups also used the bank. SVB was the main bank for this community. If you were building a tech company, you probably had an account at SVB. Because the bank worked with this one group, its customers all knew each other. Founders and investors in the tech world often talked. This made the bank's community very connected. Between the years 2020 and 2021, the technology world grew very fast. Many startups received a lot of money from investors. It was a boom time for technology. These companies needed a place to keep their new money, so they put it in their SVB bank accounts. As a result, SVB's deposits grew very, very quickly. The bank suddenly had billions of extra dollars from these new deposits. This created a new challenge. A bank uses the money from deposits to give loans. That is how a bank makes its own money. But it was hard for SVB to lend all this new money. Lending to new startups is careful work. A bank must check if a company is strong. This process takes a lot of time. The deposits were coming in much faster than the bank could find good companies for new loans. So SVB had to invest the money in a different way. The bank decided to buy assets that seemed very safe. It bought a large amount of government bonds. A bond is a type of loan to the government. Everyone believes the government will pay the money back. So these bonds were safe from credit risk. This means there was no risk that the loan would not be paid. However, there was a different kind of danger. This was a hidden problem called interest risk. The bank bought many long-term bonds when interest rates were very low. This meant the bonds paid a very small amount of money each year. If interest rates in the economy went up, these old bonds would become less valuable. If SVB needed to sell its bonds before they matured, it would lose a lot of money. This created a big, secret risk for the bank that few people noticed at the time. 4. Why the bank failed. In 2022, prices for many things in the United States started to go up very fast. To fight this problem, the U.S. central bank, called the Federal Reserve, raised interest rates. This decision created a big problem for Silicon Valley Bank. Remember, SVB bought many government bonds. Bonds are usually very safe. But when interest rates go up, the price of old bonds with low interest rates goes down. Suddenly, the bonds that SVB owned were worth much less money. This was a serious problem, but it was only on paper at first. The problem became real when the bank needed cash. At the same time, a second problem was happening. SVB's customers were mostly tech companies. These companies started to spend the money they had in their bank accounts. They were not getting as much new money from investors as before. So, a lot of money started to leave the bank. Every day, more and more customers took their money out. SVB needed cash to pay all these customers. The bank had to sell its bonds to get the cash. But because the bonds were now worth less, the bank lost a lot of money when it sold them. In early March 2023, SVB made an announcement. It told the public that it had lost almost $2 billion from selling its bonds. The bank also said it needed to find new money to stay strong. This announcement made its customers very afraid. SVB's customers were different from customers at a normal bank. They all worked in the tech world. They talked to each other online, in group chats, and on social media. Most of these companies had a lot of money in the bank, much more than the $250,000 that the government protects. They were worried they could lose everything. The news and the fear spread in just a few hours. Important people in the tech world told their companies to take their money out of SVB immediately. This started a bank run, but it was a modern digital bank run. People used their computers and phones to try to move billions of dollars. The bank could not keep up. It did not have enough cash ready to give everyone their money at once. The bank had failed. On Friday, March 10th, the government had to step in and take control. 5. The government's plan. When Silicon Valley Bank failed on a Friday, many people were very worried. The news spread quickly online. People thought the problem could grow and hurt other banks. If everyone tried to take their money out of many banks at once, it would be a disaster for the economy. The government knew it had to act fast. Over the weekend, top officials worked on a plan. Their main goal was to stop a bigger crisis from happening. They needed to make people feel that the banking system was safe. The government's plan was announced on Sunday night. It was a big surprise. Normally, the Federal Deposit Insurance Corporation, or FDIC, only protects up to $250,000 in a bank account. But many of SVB's customers were companies with millions of dollars. The government used a special power called a systemic risk exception. This allowed them to break the normal rule. They promised that all depositors at SVB would get all their money back, no matter the amount. This meant that on Monday morning, businesses could access their funds and pay their employees. The government's plan helped depositors, but it did not help the bank's owners or its leaders. This is an important point. The people who owned stock in the bank lost all their money. The value of their investment went to zero. The top managers of the bank were fired. They were responsible for the bad decisions that made the bank fail. The government's plan was not a bailout for the bank or its executives. It was an important point. The people who owned stock in the bank lost all their money. The value of their investment went to zero. The top managers of the bank were fired. They were responsible for the bad decisions that made the bank fail. The government's plan was not a bailout for the bank or its executives. It was a plan to protect customers and the economy. The government also saw another problem. Many other banks owned bonds that were losing value because of higher interest rates, just like SVB. To prevent these banks from having to sell their bonds at a loss, the government created a new program. This program let banks borrow money for up to 1 year. As security for the loan, banks could use their bonds. The special part was that the government valued the bonds at their original price, not the lower market price. This gave banks access to cash and made them much safer. It was a way to stop the panic from spreading and to make the whole system stable again. 6. How to keep your money safe. The problems at the bank taught us important lessons. These lessons can help businesses and people keep their money safe. It is important to think about where you put your money. Being smart about your cash can prevent big problems in the future. The first lesson is simple. Do not depend on only one bank. It is not safe to keep a large amount of cash in a single place. In the United States, the government insurance protects your money up to $250,000 per account. If you have more than that in one bank and the bank fails, the extra money is at risk. By using 2 or 3 different banks, you reduce this risk. If one bank has a problem, you can still use your money at the other banks. To make this easier, many banks offer special services. These are often called insured cash sweep programs. These services automatically spread a large deposit across a network of different banks. The amount in each bank is kept under the insurance limit. This gives you much more insurance coverage, but you still get one simple bank statement. It is a very useful tool for businesses with a lot of cash. You should also think about keeping some money outside of the banking system. For example, you can buy U.S. Treasury bills, also called T-bills. They are very safe because they are supported by the government. They are not bank deposits, so they do not have the same kind of risk. This adds another layer of safety to your financial plan. Finally, it is very important to have an emergency plan for your money. Ask yourself, What will I do if my main bank is closed for a week? Your plan should include having a second bank account at a different bank. You should know how to make payments from this backup account. It is a good idea to test your plan sometimes. This makes sure everything works correctly. Being prepared is the most important lesson. A good plan turns a sudden crisis into a problem you can manage. It helps you stay calm and protect your money when things go wrong. 7. New rules for banks. After the bank failed, leaders had to think about how to stop this problem from happening again. The world is different now. People can move money very fast using phones and the internet. A bank run can happen in hours, not days. The old banking rules were not made for this fast digital world. One big question was about deposit insurance. The government protects money in a bank up to $250,000. This is enough for most people, but not for companies that have millions of dollars for paying their workers. One idea is to raise this insurance limit for everyone. Another idea is to give more protection only to business accounts used for payments, like payroll. This would help businesses feel safe. But there is a difficult choice. If the government protects all money, some banks might take more risks. They may think they will always be saved if there is a problem. Another important topic was the rules for mid-size banks. SVB was a mid-size bank. The rules for these banks were not as strict as the rules for the country's biggest banks. Now, leaders are thinking about making stronger rules for them. They want to be sure these banks are safe from interest rate risk. This was the problem that hurt SVB when its bonds lost value. Leaders also want to test these banks more. They want to see if a bank can survive when many customers take out their money at the same time. It is not easy to make these new rules. Leaders must find the right balance. They want to make the banking system safer for everyone, but they also need banks to lend money to people and businesses, which helps the economy grow. The goal is to create a system that is strong enough for our modern world. 8. What we learned. Banking is built on one very important idea: trust. The story of Silicon Valley Bank is a powerful reminder of this. It showed everyone how quickly trust can break in our modern world. In the past, a bank run was slow and took many days. People had to go to the bank and stand in a line. Today, with fast internet and group chats on our phones, a bank run can happen in just a few hours. Confidence can disappear with a simple click. This event was a big lesson for all banks. They learned that they must manage their risks very carefully. It is not enough for an investment to look safe today. Banks need to think about what could happen if things change, like when interest rates go up. They cannot take big chances with depositors' money. Managing it safely is their most important job. Businesses and people also learned a lot. The experience taught everyone to be smarter about where they keep their money. It is not a good idea to depend on a single bank for all your cash, especially for large amounts over the insurance limit. Having a good plan for emergencies is very important. Being prepared can turn a crisis into a problem you can manage. The system does have ways to help during a shock. The government stepped in to protect depositors and stop a bigger panic. But the real lesson is about being ready before a problem starts. This story has changed how banks, businesses, and regulators all think about financial safety. What does it mean to be safe in a digital age? Has this story changed how you think about your own bank?
Hey there! Just a second before you go. If you learned something new today, please give this video a like, write your thoughts in the comments, and subscribe to the channel. It only takes a second, and it really, really helps to create even better English videos for you. Your support means the world. Thank you.